Right, so how we were doing, troops? In this video, I'm going to share with you the only 3 concepts that you'll ever need to understand to consistently pull money from the markets. Right, the only 3 concepts that you're ever going to need to master if you want to become consistently profitable. That's it, 3 things. If you can master these 3 things, you will know exactly what's happening on the charts at all times, and you will be able to trade with consistency. None of these airy-fairy indicators, I'm not going to go and put an indicator on your trading view and it's going to spot all of these trades for you. It's no crazy weird bot that's going to trade 1 million times a day for you. It's 3 simple concepts so you can understand where the market's going, what direction the market's going in, and how to identify when there is a good move, right? How to understand when something is going to happen. Now, I must put a quick disclaimer in here before we go into these concepts. Using these on their own will not make you profitable. These are the concepts that you're going to need to master and understand. And once you do so, you can then build those into a mechanical trading system, a clear set of rules that you can follow, that you can then go and back test, forward test, to ensure that following those rules are going to give you an edge in the market. Okay, you need to take things like timing into account, what currency pairs you're looking to trade or what markets you're looking to trade. But fundamentally, these 3 concepts are all you're ever going to need to know to find the right opportunities on the charts. Okay, so let me just share my screen and we'll go over them. So these 3 concepts here, you've probably heard of them already: market structure, liquidity, and imbalance theory. We'll go through these one by one, and I'll explain exactly why you need them, what they're for, and why they're important. So let's firstly start on market structure. Okay, market structure. Well, market structure, again, it's very, very simple. If the market is bullish and we're creating higher highs and higher lows, then obviously we're expecting price to continue to the upside. If price is creating lower lows and lower highs, well, obviously market's moving to the downside, and we then have the expectation that price is moving to the downside and it's going to continue doing so, right? Lower lows, lower highs, what direction are we moving? Down. Okay, very, 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 very basic stuff. And market structure in its simplest form, I mean, it's not so much about in its general form that it's super, super useful. It's about understanding what it tells us. And the great thing that market structure does is not only does it tell us which direction the market is moving in, it tells us when the market is changing direction as well. So when we go from creating lower lows and lower highs to that actually changing, as we can see here, prices now started to change direction, we can use that market structure shift as a key indication as to when price is going to be turning around, right? Because the market is literally telling us, nope, I'm not going down anymore, I'm now going up, okay? And we can use that to be able to time our entry into the market, right? Because ultimately as traders, we're trying to follow the market as it goes from being, it goes from pulling back to changing direction and going to the upside, right? We're trying to predict these changes in direction, fundamentally. Okay, obviously as well as that, we're trying to obviously predict the continuations, but again, for this example here, identifying and using market structure, being able to master this concept to not only identify the direction of the market, but also identify the change of direction of the market, okay? Now, as well as that, one of the great things that market structure does is, it's a very, very clear and obvious concept to a lot of people. Professionals, retail traders, new traders, dummy traders, and this kind of moves on to the next concept, which is liquidity. Now, if you can understand market structure in its most basic form, you can then utilize that to be able to identify liquidity. Now, the great thing about liquidity is it allows us to identify where those potential turning points in the market are going to be. Okay, the market moves for one reason, from point of liquidity to point of liquidity, right? It will run what we call buy-side liquidity, and then it will run to sell side liquidity. Liquidity is literally the fuel of the market. If liquidity has not been taken, we cannot expect the market to move in the intended direction, right? It's as simple as that. So you can kind of see here how this here is actually structure, okay? And what structure does, structure builds liquidity into the market. Okay, so all of these structural highs or these structural lows, we are going to see what we call liquidity pools. When those liquidity pools are taken, when those liquidity pools are run, like we can see has happened here, that is essentially the market going to take its fuel so it can execute in its orders to move in its intended direction. Okay, as we can see has happened here. Okay, the market is ultimately bearish, but that in turn has built liquidity. Price has then turned around, run liquidity before turning back around and heading in its intended direction. Okay, so if you can identify market structure, you can very quickly identify points of liquidity. Okay, and again, with these two concepts understood, you will then have the right ideas and the right knowledge to begin building a pretty comprehensive mechanical set of rules. Okay, so not only can we use market structure to identify liquidity, but we can then also identify market structure to tell us when the market is changing direction. Okay, so we might look at liquidity on a higher time frame. We then might look at market structure on a lower time frame within this point to tell us when the market is changing direction. Okay, because what has then happened is the market has run liquidity to take its fuel, to fuel itself up, before market structure turns around, changes direction, goes from bullish to bearish, before intending in its direction. So this type of moves that we want to be looking to trade are a run on liquidity, market structure changes direction, and then we can look to trade away from that liquidity sweep, right? So one of the key things you always want to do, you want to trade away from that liquidity sweep. So we're going to run to the upside, we're going to take liquidity, and we're going to run to the downside. Okay, for example, here, we might run to the downside, take liquidity, and run to the upside. Okay, so market structure tells us which direction the market's moving in and when it's changing direction. Liquidity tells us the points at which the market can change direction, okay, where the fuel is for us to take to actually fuel these moves, to fuel these market structure shifts and these market structure expansions, okay? Now, the final thing, the final concept that you want to understand is what we call imbalance theory, okay, or fair value gaps, or, I mean, there's a million different words and people complicate this to the moon and back, right? There's a million different words, but fundamentally everything's the same. It all means the same thing. So imbalance theory is something that we can apply to our trading to identify when there is actually volume coming into the market, right? When there is actually something happening. When we see that there is an imbalance present in the market, that is essentially confirming to us that, okay, great, the move that I'm predicting is happening. There is actually some sort of substance behind it, right? There is actually some sort of buying and selling going on here that has caused this imbalance to be created, right? There is actually some sort of volume coming into the market. So to start off with, let me just explain exactly what an imbalance is. So we've got two examples here. The first example is where we would consider an imbalance. Okay, and we can see here what has happened is, so this is what we call a 3-candle formation. Okay, we've got 1 candle, 2 candle, 3 candle. And an imbalance is when the wick or the tail of the first candle and the wick and the tail of the third candle do not touch, right? We can see that between this point here and this point here, there is a gap, okay? This is an imbalance. Now, firstly, what this shows us is, it shows us that there has been a significant amount of volume coming into the market at that point, which means that the market has not been able to rebalance itself. So imbalance theory tells us that when there is an imbalance present, the market is likely to want to return back to that imbalance to rebalance the market, okay? Now, on the other hand, we then have what we call a balanced market, right? The market is moving and exchanging hands as it should be. Okay, and we can see here that the wick of the first candle and the wick of the third candle, there is no gap, okay? They touch. Okay, so that tells us that there is no need for price to come back to this area before continuing to the downside, okay? Or in other words, it shows us that there isn't really too much going on here. There's no sort of surge in volume. There's no increase in volume here that has caused the market to move in such a way that has created an imbalance in the way price is being delivered. Okay, now, how is this applicable to your trading? Well, if we are looking to, for example, catch a move like this, right? We're looking to trade from liquidity. We're looking to use market structure to predict that turning point. For us to get that last piece of confirmation, we can use imbalance theory just to make sure that this point of liquidity here is actually going to do something, okay, or gives us a better probability of actually catching that. So, for example, if we see an imbalance in this market structure shift here, that tells us that this liquidity sweep has actually done something, right? There's actually some sort of substance behind this move. Okay, so it gives us confirmation that, okay, great, there is actually volume coming into the market from this point of liquidity. And great, fantastic. It's a trade that we could actually potentially be looking to take. Okay, so a quick recap on this, just to keep this video short and sweet. Market structure tells us which direction the market is moving in and when the market direction is changing. Liquidity tells us or shows us where potential turning points in the market are going to be. Okay, where is price going to want to run to? Where is price going to potentially run away from? Okay, because the market fundamentally moves from buy side liquidity to sell side liquidity. That's it. It runs from liquidity to liquidity. Okay, so if you can identify and flow with that, okay, and you can identify ways in which you can trade around that, there's some incredible moves to make. Okay, and then you can use what we call imbalance theory. Okay, we can use imbalance theory to solidify that idea. Okay, to say to us, okay, fantastic. Well, we've run this point of liquidity. We've seen the market change direction, and we see that there's an imbalance in there. Well, it must mean that this point of liquidity is strong. This market structure shift is actually going to cause price to change direction. So, do I have a trade? I potentially do. Okay, so if you can master these three concepts, you will have every piece of knowledge you need. I mean, most pieces of knowledge. I mean, not every piece, right? There's always going to be parts in there that aren't trading related, that are risk management, price delivery model related that you're going to want to understand as well, timing and stuff like that. But fundamentally, you do not need any more technical concepts than these three to consistently pull winning trades from the market. This is all there is. This is all there is. This is all we need to understand. Okay. So I'm going to keep this one short and sweet. I mean, it's 13 minutes long already. So take this away. Do what you please with this information. Again, you're still going to need to build mechanical rules up with this, ensure there's an edge, all of that good stuff. But if you have any questions around this, please let me know. But like I say, there's a million different ways to trade. There's a million different people telling you a million different things. But fundamentally, this is all you're going to need. You don't need indicators. You don't need any of these stupid beginner trading strategies that are just creating liquidity in the market. Okay, focus on these three systems or these three concepts. It's all you're ever going to need. So please take it away, do your research, figure things out. And if you do need any help, put a message in the comments and I'll see you in the next one.